Akhil and his friend Gayatri are chatting about investments when Gayatri informs him about a new fund offer from a good AMC. Akhil asks her if she's interested, to which Gayatri says she is but doesn't know what is a closed-ended fund. Akhil said that even he never paid any attention to it. It is better to have an outlook from an expert on that. He in fact suggested Gayatri to watch Money9. Now, most mutual fund investors probably don't pay much attention to whether their fund is open-ended or closed-ended. The truth is that when most people talk about mutual fund investments, you can assume that they are referring to open-ended funds. Mutual funds are classified as either open-ended or closed-ended based on their structure. The main difference, however, between these two types of funds is the liquidity and the simplicity upon which the sale and the purchase of the fund units are based. Now let's understand in more detail what open-ended and closed-ended funds are and what the difference between them is. A closed-ended fund is a type of mutual fund that is launched with a fixed number of units by a fund house. It also has a predetermined maturity period. Once the new fund offer, which is the NFO, is closed, no further investments can be made in it. Assets are accumulated in this mutual fund through an initial public offering, which is an IPO. In simple terms, a closed-ended fund closes after the initial launch period and continues to operate until maturity. This provides the fund manager with additional convenience in fulfilling the investment objectives of the fund. Like all mutual funds, closed-ended funds also have an expense ratio which can often go up to 2%. Now let's understand what open-ended mutual funds are. In open-ended mutual funds, there is no limit to the number of units that can be issued. Investors can buy or sell units from a fund house based on the current net asset value (NAV) of the scheme on any given day. Their NAV is based on the performance of the underlying securities of the fund. Now, these schemes do not have any maturity date.
जैसा कि नाम से प्रतीत है, क्लोज एंडेड होते हैं, यानी कि इनका एक डिफाइंड पीरियड होता है और उस पीरियड के बाद मैच्योर हो जाते हैं। इस पीरियड के अंदर एक तरह से एक लॉक इन हो जाता है, यानी कि आप जो है और खरीद नहीं सकते और इसको बेच भी नहीं सकते। सिर्फ एक पर्टिकुलर डेट या मंथ में ही जो है म्यूचुअल फंड कंपनी विंडो दे सकती है इसमें से एग्जिट करने का, बट अदरवाइज क्लोज एंडेड फंड जो है वो एक फिक्स पीरियड के लिए निकाले जाते हैं। इसके विपरीत ओपन एंडेड फंड में आप कभी भी खरीद सकते हैं, बेच सकते हैं, कोई एडिशनल इन्वेस्टमेंट कर सकते हैं, आप थोड़ा या ज़्यादा या पूरा का पूरा इन्वेस्टमेंट निकाल सकते हैं, तो आप पूरी तरह से स्वतंत्र होते हैं ओपन एंडेड फंड में।
The main difference between open-ended and closed-ended mutual funds lies in liquidity, which refers to the ease of buying and selling. In open-ended mutual funds, you can easily redeem the units. You can visit the asset management company's office or sell them online through a demat account. The AMC will purchase the units from you at the current NAV. On the other hand, in closed-ended funds, you can purchase units only during the new fund offer period and your investment is locked in for a predetermined period. Moreover, you can redeem the units only upon maturity, which means you cannot sell them before that. However, SEBI has introduced a mechanism to provide some liquidity to investors. After the NFO period ends, the stock of the closed-ended fund is listed on the exchange and can be traded like shares. This means that investors can sell their units in the market if they wish to exit. However, they will not receive any returns because the fund house does not buy back the units. Instead, the transfer takes place between investors. For the investor who purchases units on the stock exchange, they will also have to wait until maturity to redeem the units. The net asset value (NAV) of a fund reflects its true value, while the trading price depends on the demand and supply of the units. Unlike closed-ended funds, the units of open-ended funds cannot be traded on the share market. One advantage of open-ended funds is that they offer the opportunity for systematic investment through Systematic Investment Plan (SIP). On the other hand, closed-ended funds do not provide the facility of SIP and you have to make a lump sum investment. Both the funds are taxed similarly. Same tax rules are applied on them that are applied on mutual fund. Now, if you invest in a closed-ended fund at the time of its launch, you need to have a lump sum amount available for it. This cannot be considered a prudent financial decision. There can be risks involved. For salaried individuals, it may not be feasible to make such a single investment. People in such situations prefer investing in small amounts through a systematic investment plan, that is SIP. In an open-ended fund, investors can assess the performance of the fund in different market conditions or cycles because historical data is available. On the other hand, there is no such track record available for closed-ended funds. Therefore, investing in a closed-ended fund carries higher risk. There is a considerable amount of uncertainty involved because investors may not have a clear understanding and they have to rely entirely on the fund manager. In a closed-ended fund, investors cannot redeem their units before the maturity date. So, fund managers have a certain asset base to work with. They are not overly concerned about preserving their capital because there can be no early redemptions. Similar to stocks, the buying and selling of units in a closed-ended scheme occur on the stock exchange, but the price depends on the demand and supply. If there is increasing demand for units of a closed-ended scheme and the supply is limited, the sale of those units will happen at a higher price than the net asset value (NAV). Now, let us look at what kind of investors should invest in closed-ended funds. Experts believe that closed-ended funds are suitable for investors who can maintain patience and hold their investments for a long time. It is often observed that in the stock market, small investors tend to invest in stocks or mutual funds when there is a bull market, and they start selling shares out of fear during a bear market. However, investing in closed-ended funds means that investors can avoid such wrong habits and keep their money invested for a long time. Fund managers of these funds can also choose good stocks for their portfolios with confidence, considering long-term prospects without worrying about short-term performance.
देखिए, आइडियली अगर हम बात करें तो ओपन एंडेड फंड ज़्यादा बेहतर माने जाते हैं, क्योंकि उसमें आपको आप कभी भी जो है लिक्विडिटी अवेलेबल रहती है और आप अपने होराइजन के हिसाब से क्लोज एंडेड फंड में निवेश रख सकते हैं। अगर आप नहीं निकलना चाहे और लंबा इसमें निवेश करना चाहते हैं तो वो कर सकते हैं। और दूसरा जो सबसे बड़ा मुख्य कारण है वो ये कि लिक्विडिटी आपके पास अच्छी होती है। आप पूरा निकालना चाहे पूरा निकाल सकते हैं, कम निकाल सकते हैं, 2 साल हो गए उसके बाद निकाल सकते हैं। तो ओपन एंडेड फंड जो है आपको एक अच्छी लिक्विडिटी और इन्वेस्टमेंट रेवेन्यू देता है। वहीं क्लोज एंडेड फंड क्योंकि फिक्स्ड मैच्योरिटी है और क्लोज्ड है, तो आप केवल वो निवेशक निवेश करता है जिसको कि पता है कि 3 साल के बाद मुझे ये फंड जो है मिल जाएगा और उस फंड को मैं यूटिलाइज कर दूंगा। तो जहाँ यूटिलाइजेशन आपका पूरी तरह से फिक्स्ड है, वहाँ पे क्लोज एंडेड फंड जो है बेनिफिशियल हो सकते हैं।
So it is clear that closed-ended funds are not suitable for all investors. If an investor desires higher returns in a short period of time, then open-ended funds are the only option. Both categories of funds have similar tax and expense structures. Investors who do not want their money to be locked in for a long time can invest in open-ended mutual funds. However, if you have sufficient disposable funds and can invest in them for a long time, then you can feel confident by investing in closed-ended funds.